Hello and welcome to Module 1 of the Stock Market Masterclass, Fundamental Analysis. In the third section of the Fundamental Analysis module, we will look at the different ways an investor can value a share to help understand its true value. In this lesson, we will learn what the term earnings per share is and how to apply it. We will learn about the importance of price to earnings ratios. We will learn important share valuation metrics. And we will learn how to determine a fair value for a share. Now that we understand which sectors are expected to perform best at different stages of the economic cycle, we can delve deeper and start analysing the different companies inside the sectors. Purchasing individual shares is a relatively easy process in trading terms, as a trader just has to pay the market price to own the shares. But how does the trader know if they are paying too much? There are techniques that can be applied to individual companies that can help an investor determine if the share is overpriced, underpriced, or at fair value, and these are extremely important parts of the analysis process. Just because a market sector is performing well, it doesn't necessarily mean that all of the individual companies categorized under it will have the same performance. The role of financial analysts involves experts understanding all company financials, including balance sheets, profit and loss statements, and all manner of financial documents. Analysts are generally experts in a particular field and have a high level of understanding that is simply not possible for the average investor. However, this is not the only way to value a company, and there are tools that are available to all investors that can break down this process and give them a very good understanding of the financial health and prospects of a company. The following tools can help investors separate the performance of individual companies and help them determine which shares to choose when building and managing their share portfolios. Let's first look at earnings per share. Earnings per share, also abbreviated to EPS, is a ratio that measures a company's net earnings against the total number of outstanding shares for a fixed period of time. The EPS calculation is a company's net profit after tax divided by the number of shares outstanding, which is the number of the company shares currently held by shareholders, also referred to as shares on issue. A high EPS ratio is good for a company because high earnings means the company has more money available to reinvest in the business to potentially expand or distribute to shareholders in the form of dividends. Now let's look at the factors that EPS ratios don't account for. It is important to understand that the EPS ratio should not be the only measure used to determine if a share is a good buy, because this ratio does not convey information about the financial health of the company. Although year-on-year growth of an EPS is considered a good thing, it is possible for EPS ratios to be misleading. As an example, a company can buy back its own shares, which effectively reduces the number of shares outstanding. This means that the EPS ratio can increase without an increase in the net income. The EPS calculation does not account for a company's outstanding debt levels. Although the EPS is calculated using a net profit amount, which would account for debt interest repayments, a change in market conditions, like rising or falling interest rates, can have an adverse effect on a company's profitability without an increase or decrease in sales. Another important factor that isn't considered in the EPS calculation is the amount of capital required to generate that income, which therefore makes it difficult to compare like-for-like companies just on an EPS basis. See in the example on the screen how the two companies have the same EPS, but one of the companies uses twice the capital to generate the income. The second company is most likely more efficient and could be a better prospect, but this is not reflected in the EPS calculation. We can now see that the EPS is an important tool to help determine the amount of a company's net profit that can be attributed to each share. Now, although this information is important, it should not be used in isolation when determining which shares to buy, but rather as a guide to the company's profitability. Let's now look at price to earnings ratio. The price to earnings ratio, also known as the PE ratio, measures a company's current share price relative to its earnings per share. The calculation for the PE ratio is simply the current share price divided by the earnings per share. It is widely accepted that the PE ratio is one of the most important analytical measures of a company to compare its value from its own historical records, or to compare them against other companies. One of the main functions of a PE ratio is to help determine the value of a company. This insight allows investors to make informed decisions based on the earnings potential, as higher PE ratios suggest higher growth prospects. Although high PE ratios are generally viewed as positive by investors, it is important to understand that this information alone doesn't disclose whether a share is overvalued or undervalued. A way to interpret the PE ratio of a company is to look at how many years it would take for the company's earnings to pay back the current share price. As an example, say the current share price of VHP is $40 and its EPS is $2. The PE ratio would be 20. Now to put this information into context, at a current PE ratio of 20, VHP would take 20 years for its earnings to match its current share price. Whether or not this is a good number for VHP depends on a few factors, including year-on-year PE ratio fluctuations, consistent earnings, and share price volatility. As an example, if VHP's earnings are consistent year-on-year and the share price remains relatively stable, the PE ratio isn't likely to have a large swing. If we compare this to a volatile company in the same industry, say XYZ, who experience wild fluctuations in their share price and inconsistent seasonal earnings, although the PE ratio may also be 20, it cannot be viewed with the same confidence as the PE ratio of VHP. So what does a high or low PE ratio tell us? A high PE ratio suggests a potential for higher growth, but it is important to understand the dynamics of why. A high PE ratio indicates that the share price has risen faster than the company's earnings because investors are expecting a high level of earnings in the future. This is a market expectation and subsequently increases the value of the share price, but this doesn't always translate to reality. When this expectation is not met, for example, a poor earnings report or downgrades, indicating that a share is overvalued, these shares often experience sharp falls which far exceed the general market. A low PE ratio indicates that the share price has fallen while company earnings may have remained relatively unchanged. As we have already learned, share prices can fall for a variety of reasons that don't directly relate to the individual company, and thus, in these circumstances, the company could maintain steady earnings. It is also important to remember that large companies often pay out a large percentage of their earnings in dividends to shareholders, and as this decreases the net income, it causes the PE ratio to be lower than companies that pay small or no dividends. This is where investors often find the real value in shares and capitalize on purchasing them when they are potentially undervalued but can still offer good value through dividends. So what is the optimum PE ratio? This is a question that has no easy answer, as PE ratios can vary greatly from company to company and sector to sector. A good rule of thumb is to compare the PE ratio of the company you are analyzing against companies in the same sector, the broader index or the sector itself. As an example, if XYZ Bank has a PE ratio of 20 and the finance sector index has a PE sector ratio of 28, this may indicate that XYZ is cheap relative to its peers and may outperform the sector in the future. Conversely, if XYZ Bank has a PE ratio of 37 and the finance sector index has a PE ratio of 28, this may indicate that XYZ is potentially expensive relative to the finance sector index and may fail to meet expectations or profit forecasts. The PE ratio is a very useful tool for investors, but like EPS, should not be relied on in isolation. This ratio can sometimes exaggerate the company's positives and negatives and does not factor in important information such as debt levels, dividend yields, or market cycles into the calculation. Let's now talk about share valuation metrics. The first two analytical tools we learned about focus on earnings of a company, but as I mentioned earlier, neither give any information regarding the financial health. The next tools we will cover will provide a deeper understanding of the financial health of a company by integrating important elements like debt and asset values into the equation. The first one we will look at is price to book ratios. A price to book ratio is a common tool used to measure the value of a company's equity, which is its book value, relative to its market value, the share price times the shares outstanding. Essentially, the book value of a company is the company value if it liquidated all of its assets and paid off all of its debt. The calculation for the price to book ratio, also known as the PB ratio, is worked out in three parts. Firstly, we need to work out the book value, which is the company's tangible assets minus total company liabilities. This information can be found in the company balance sheet in the historical annual report section on the company website. We now need to divide the book value by the number of shares outstanding to work out the book value per share. Finally, we divide the company's current share price by the book value per share to reach the PB ratio. As an example, XYZ has a market capitalization of $100 million, a book value of $150 million, 200 million shares outstanding, and its current share price is 50 cents. As you can see in the example on the screen, the PB ratio for this company is 0.66. In this example, XYZ has a PB ratio of less than 1 and could be undervalued, as its book value, which is its assets, is greater than its market value. PB ratios are useful when assessing the viability of purchasing shares in a company because the ratio gives you an understanding of what the company is worth if it closed its doors and sold up everything today. If a company has a PB ratio of less than 1, it means that it is trading on the market for less than the value of its assets. Now, although this doesn't guarantee that the company will rise in value to equal its asset value, it could suggest that the company's share price is undervalued relative to its assets, which may act as a safety net for the share price. Conversely, the higher the book value, the higher the premium investors are willing to pay for a share in the company above its tangible assets. Companies trading with high PB ratios can sometimes be considered overvalued, which creates a market risk, as adverse market movements due to underperformance are often exaggerated. PB ratios are useful to investors because they provide a constant metric that can be easily compared to a company's share price. It is also a good metric to use when comparing like-for-like companies, as sometimes the PB ratio can uncover hidden value, especially if a company is trading under 1. Another important use of the PB ratio is for companies that have negative earnings, like some technology companies in their early days and startup companies. Negative earning renders EPS and PE ratios useless, where PB ratios can provide an investor with more insight to the real value of a company without the consideration of earnings. Once again, a PB ratio should not be used in isolation, as the information can often be misleading. Remember that only a company's tangible assets are considered in the calculation. Intangible assets, such as intellectual property and goodwill, are an extremely important factor when determining the true value of a company and should be considered as part of the analysis process. Let's now talk about price-to-sales ratios. The price-to-sales ratio, also known as PS ratio, is an analytical tool which can be used to compare a company's stock price to its sales. Essentially, it is a ratio that shows how much an investor is willing to pay per dollar of sales for a share. PS ratios are best used when comparing companies in the same sector that are like for like, as sectors have significantly different revenue streams. The calculation for the PS ratio is worked out in two parts. Firstly, we need to work out the sales per share, which is calculated by dividing the company's net sales for a 12-month period by the number of shares outstanding. We can then work out the PS ratio by dividing the company's share price by its sales per share. As an example, XYZ has a net sales of $100 million, 200 million shares outstanding, and a current price of $5. So the PS value for this company is 10. A low ratio may suggest that a company is undervalued, whereas a high PS ratio may indicate an overvaluation for that company. Similar to the previous ratios we covered earlier, the best way to find out the average PS ratio is to average out the PS ratios of the other companies in the same sector or compare it to the PS ratio of the sector index itself. Another use of the PS ratio is to use forecast sales data for the current year, referred to as forward ratio. This can be beneficial to an investor's analysis because they can be used to project targets to compare with historical figures, which can help highlight if a company's sales are increasing, decreasing, or remaining stagnant. Forward ratios are useful if an investor is comparing companies in the same sector, as a company with a better forward forecast of sales will generally outperform stagnant sales figures from its peers. Current and forecast sales figures can be found on a company's balance sheet in their financial statements. It is important to note that the PS ratio doesn't account for whether a company makes a profit, so like the previous ratios covered so far, it is always best to use the PS ratio as part of an overall analysis approach and not in isolation. Let's now look at debt-to-equity ratios. The final analytical tool we will cover is the debt-to-equity ratio, also known as a DE ratio. The DE ratio is used to assess a company's financial leverage. The DE ratio is calculated by dividing a company's total liabilities by its shareholder equity, which is its total tangible assets minus its total liabilities. The information to work out the company's shareholder equity can be found on the company's balance sheet in their financial statements. As an example, XYZ has total liabilities of $50 million and a shareholder equity of $150 million. We can see that this company has a DE ratio of 0.33. The DE ratio is very important to investors to help them determine if a company has very high leverage, which could potentially make them a significant risk in a market downturn. A high DE ratio suggests that a company may have been aggressive in financing its growth by accumulating significant debt. Now, this doesn't necessarily mean that a company is not a good investment if the ratio is high, because they could be generating more income by using the debt than they would without it. As long as the extra income generated by the high debt is more than the interest repayments on the debt, it will be a positive for shareholders. Unlike the other ratios we covered earlier, DE ratios are difficult to compare against other companies, so it is best to apply this ratio with other forms of analysis. It is important to remember that high leverage will always increase risk, so using a DE ratio to evaluate a company's level of debt should always be considered part of any analysis process. Now let's talk about determining the fair value of a share. Now that we have an understanding of the key metrics an investor needs to consider when trying to determine the fair value of a share, let's summarize the process. Step 1. An investor needs to understand the earnings potential of the company they are analyzing, so working out the EPS is an important part of the process. The information on the company's net profit required to work out a company's earnings per share can be sourced from the balance sheet in the company's financial statements through most trading platforms, the ASX website, or the company's website. Step 2. Once the EPS is known, it is easy to work out the PE ratio by dividing the EPS into the current share price. Once the PE ratio is calculated, you can compare this figure with other company PE ratios as well as the sector index PE ratio. Now you're in a position to make an assessment as to where the company is placed against its peers and the sector in terms of growth and earnings potential. Step 3. An investor also needs to know a company's equity relative to its market value. Once the price-to-book ratio is known, you can make an assessment as to whether the company is in a strong financial position relative to their assets. If the company you're analyzing has assets that exceed the current market value, then it could be undervalued with a potential safety net to help protect it. Step 4. The next step is to calculate the PS ratio to determine how the company stacks up against its peers and its sector in terms of sales revenue. It is a good idea to also carry out the forward ratio to understand what the forecast looks like compared to similar companies in the same industry, as this may help identify growth opportunities. Step 5. The final step is to apply the DE ratio to gain an understanding of how much debt the company is using to fund its growth. If the debt level is high, it is always a good idea to compare it to similar companies in the sector to identify if this is common in the industry. As I mentioned earlier, you can't easily compare debt levels from company to company fairly, but you can still gain an understanding of how the debt levels work for that sector. As an example, if the company you're analyzing is the only one in that sector with high debt, and the forward earnings forecasts are comparable to the others, it may indicate that the company is over-leveraged and potentially at higher risk than its peers. Following the steps that we've just described will give an investor a great understanding of the company they're analyzing using a wide breadth of metrics. Although each of the ratios aren't as useful in isolation, when combined, they can provide a very powerful insight into a company's prospects and growth potential. In this lesson, we learned what the term earnings per share is and how to apply it. We learned about the importance of price-to-earnings ratios. We learned how to apply important share valuation metrics. And finally, we learned how to determine a fair value for a share. This concludes Section 3 of the Stock Market Masterclass, Fundamental Analysis. In the final section, we will learn about the top-down and bottom-up analysis methods, both widely used analytical approaches that help identify quality investments at a fair value.